RBC Managing Director and co-head of Global Financials Research. Gerard Cassidy joins us now. Gerard, always good to see you.
Thank you, Melissa. Thank you for having me back.
Which are you? I mean, I know you're watching all of them, Gerard, but in terms of like the one that is sort of garnering the most investor interest, which one would it be? Because you could say, you know, Citi, turnaround story, maybe highly valued, JP Morgan, fully valued, Wells Fargo, is it really out of the penalty? I mean, there's so many different storylines for these.
No, that's very fair. And I would say that, you know, the bellwether, of course, is JP Morgan, and it has been for a number of quarters or years for that matter. And it's a very diversified revenue mix, as you well know. But I think within JP Morgan, and as well as Citigroup and the others that have the big investment banking and trading operations, that will be the focus point, primarily because those numbers should be very strong due to the strength of the capital markets in the third quarter. But the other thing I think investors are going to focus in on is also consumer credit. And you'll see that with all of the banks that have the big credit card portfolios, including Wells Fargo, on what the trends are in that area as well.
Gerard, it's Tim. I guess the question I have that's the most important question for me is, are banks truly re-rating? You're an analyst. You look at the trends. You look at the margin trends. You look at the regulatory tailwinds. And we've come out of, we know where we were 15 years ago, where we were coming out of the great financial crisis. The dynamic for banks seems to me that this group deserves a better multiple than they've ever had, whether it's price to book, whether it's PE. Your thoughts on that?
Tim, I think you're going in the right direction, and I'm in that, you know, traveling down that path as well. But as you pointed out, you know, you look at what happened during the financial crisis, and we really have to go through a full cycle to really be able to say, okay, the banks deserve to be permanently re-rated. And the reason being is that credit is so important to the profitability of a bank, and credit is tested in a down cycle, as you well know. And so what I would say is that when you look at the valuations for the group on average, you know, some banks like a JP Morgan is at a very high valuation, but the group on average is still slightly below the cyclical highs of January of 2018. But if they get through whenever that next credit cycle comes, and they get through it without any significant losses or depreciation of book value, then I think I'm in your camp. We will see a re-rating of the banks.
Gerard, as I've said, you are in the Hall of Fame, so I'll ask you this question. Fifth Third for Comerica, $11 billion. First of many or a one-off? Because one of the bull cases for the space was M&A activity in 2025-26.
Guy, thank you. You're very kind with those words. And I would say one of many. You and I have been talking for years, and we've been around for a while. And when you turn back the clock to the 1980s, we had 18,000 banks and thrifts in this country. We're down to about 4,300 today. Will we see more consolidation? Absolutely. Small banks being acquired, and then the big regional banks, like you just mentioned, a Fifth Third buying a Comerica. What was unique about that deal that the Fifth Third guys were able to achieve because of the valuation and the pricing, Tim Spence, the CEO, is very focused on growing tangible book value per share and not diluting it. And this deal was not dilutive to tangible book value per share. And you cannot say that about the other deals. So you got to tip your hat at Fifth Third to be able to do it. But I do think this is going to be the start of many more deals over the next 12 to 24 months.
Gerard, do you have a preference right here, money centers versus, let's say, the more, investment banking leading ones? We know that, deal activity's picked up. We know the trading's been really robust. And then you do have that yield curve that's steepening here a little bit. Do you have a preference?
And it's really the question at hand, and it's the one to ask, because the money centers this year, because of what you just mentioned, the deal activity, trading have really outperformed the regionals. But we think there's the likelihood is the regionals could provide the leadership over the next 12 months under the following scenario, where the economy remains healthy, grows, let's call it 1.5% to 2%. The Fed cuts rates another 50 basis points over the next 3 to 6 months, and you get a steeper yield curve. It's been 20 years since the Fed funds rate's been over 3%, and you had a plus 75 basis point yield curve. And if we have that net interest income, which is where the regionals really excel, you're going to see that grow faster than most people expect. And then if we get the loan growth to pick up because of a resilient economy, plus the increase in capital expenditures being financed with commercial loans, I think you could find the regionals lead the space in 2026.